Hi, I'm Karim for Trade Talk Tuesday. Today, we're going to talk about calls and puts. Okay, what's the difference between a call and a put option? So when you're trading options, you can speculate on the value of a company's stock increasing or decreasing. Okay, if you think it's going to go up, you buy a call. If you think it's going to go down, you buy a put. Simple as that. Okay, so you have the right, okay, but not the obligation to buy the underlying stock at that price. This is what an option is. When you have an option, it's an option. I have a right. I'm not obligated, but I could do it if I wanted to.
I can do what I want.
Most option buyers don't use that right. They usually get in and out of this option long before the expiration date because they don't really want to buy the stock, even though you have the right to. So you purchase a call option if you think this value of a stock is going to go up. And if you speculate correctly and the price of the stock does go up, you make a lot of money, a significant profit, as they call it. On the other hand, a put gives you the right to sell a stock at a specific price up until the expiration date. So you purchase a put option if you think the value of a stock is going to fall. Now, for example, a pharmaceutical company, a biotech, is coming out with a drug trial. But you've got your brother-in-law told you that, he's studied this a lot and this drug is really not that good and it's probably not going to work. So you buy a put option on it. That biotech stock opens, doesn't get approval from the FDA, it crashes, your put option goes to the moon.
They thrive on our suffering.
Now your sister-in-law says, hey, this other company, I know about their cancer drug and I think it's going to be a home run. You buy a call option to speculate. FDA comes out, gives it approval, stock goes up, you have a call option, your call option goes to the moon, okay? So this is how it works. Put options if you think it's going to go down, call options if you think it's going to go up. So if you speculate correctly and the stock price goes in your direction, you can make a lot of money, okay? So there is a difference though, okay? Because they can both lose money too. But call options have unlimited gain potential because the stock price can go to the moon, literally go to the moon. It can keep going to the infinitely going up. On the other hand, put options are limited in their gains because, if a stock's trading at 20 and it goes to zero, that's $20. That's it. Can't go negative. There is no negative pricing in the stock market. So put options are limited in the potential gains, but I do like using put options as opposed to shorting a stock because when you short a stock, you can really get hurt because then your losses are unlimited. Whereas if you buy a put on that stock, your loss is defined ahead of time.
Slow down.
So bottom line, when you're trading options, both puts and calls, you're always speculating on which direction the market or stock will move in a given time frame. If you want more information, click on the link below for a free guide to puts and calls. I'm Karim for Trade Talk Tuesday.